So welcome, friends. So we'll be looking at the monthly outlook for the month of October. So before we go there, I just want to briefly touch upon the key events during the month of September that can have a bearing on the equity market as a whole. So starting with the key event for the markets, which happened in September was the Fed rate cut of around 50 basis points. Now, after a very steep interest rate hike that we have seen, this one of the steepest hike that we have seen in the past, so many years, the Fed finally decided to, cut rates, and a few of the forward-looking indicators such as inflation, unemployment rate were within the Fed comfort range. That kind of resulted in Fed taking this decision. Now, this has a bearing on markets across the globe. What we have seen is some of the central banks across the globe already have gone ahead and cut rates, and perhaps India may also follow suit in the coming quarters. Looking at the performance of the broader indices, so post this Fed rate cut, most of the markets across the globe did well. Same was the case with Indian markets. If you see the frontline indices, BSE Sensex, 30 or 100 did extremely well. Uh, some of the pockets within the small and mid cap were a drag, and what we're seeing as a trend is some of the mid cap and the small cap indices are faring worse than the large cap indices, so not participating in the rally as much, given what they have done in the past few 1.5 years. Also, moving to global markets, what we have seen is emerging markets did extremely well with an approximately 6.7% increase. And this was mainly to do with the fact that China as a market did extremely well, which has also a significant weightage within the EM index. So if you were to look at it, the Hong Kong index as well, China index did one of the best returns in so many years after going through a challenging period in the past 4 5 years. Now, this had was primarily driven by some of the policy actions by the central bank, the PBOC of China, wherein they were supporting some of the residential mortgage sector as well as interest rate cuts, as well as some of the funds to prop up the Chinese market in terms of stabilization. So some of these actions kind of help these markets do well, but it remains to be seen, how effective they would be going forward, because we have seen some of the false starts similarly in the past, but that has not helped. Uh, Coming to some of the sectoral performances, so as you can see, metals on the China news did well because China, has been exporting quite aggressively across the globe and depressing the global prices, be it for steel or some of the other products. So now China consuming again, domestically might have a bearing on the global prices. So that helped. On that news, the BSE metal was up almost 7.2%. The other key sectors were the auto sector, which was up around 3.4. IT, after doing well in the past 2 3 months, took a breather with about 2.5% decline. Now, coming to some of the sectors which kind of affects largely our portfolios, one is, of course, banks. So, if you were to look at it, bank had a reasonably good month in September. But what we are seeing is some of the new developments are some of the policy actions by RBI, be in terms of risk weight increase, uh, asking some of the banks to curtail the credit and deposit ratio, and so on and so forth, had a bearing on the credit growth. So what we are seeing is the credit and deposit gap is kind of narrowing after being in a wide range in the previous few months. And incrementally, there are some developments in terms of asset quality also. We are seeing some of the sectors such as MFI, credit card, personal loans, reporting certain high delinquencies. So it is best to stick to, some of the well-known names who have a proven record in terms of underwriting. And going forward, we also expect there'll be a difference in terms of how market perceives a good underwriter versus not so good underwriter, which was kind of absent in the past 2 years post-COVID. So we are incrementally positioned well within this space. The other key sector was on the autos, which have phenomenally done well in the recent past. But your incremental monthly volume numbers, if you were to look at YOY, so there is some weakness that we've seen in most pockets apart from two-wheelers, which seems to have done well, in terms of inventory built up for the festive season. But some of the other segments within the auto, that is passenger vehicles, MHCV, CV, are going through a downtick phase. Tractors by normally is doing well, given the good monsoons and the festive seasons ahead. So we are incrementally, we were positioned quite well within autos, but incrementally we have been cutting our weights primarily due to the valuations. The other large sector is, of course, IT, which has again done well. Now, there was an expectation of a demand pickup. So far, what we are hearing is that demand pickup is more gradual in nature, and it would take time for the tech spends to come to IT services. So far, the tech spends, which most of the large enterprises across the globe are doing, are primarily going to some of the hardware spends, but it would take time for it to get converted to IT services spends. So we are kind of watching and waiting the space quite closely. So we are also positioned in this segment, looking for a demand revival. Lastly, some of the key trends that we see across the BSE 500 larger index, if you were to look at it. So last year was a phenomenal year in terms of earnings growth, the top line growth. Few reasons were, the inflation impact, and as a result, inflation coming down, but some of the players choosing to do a price hike, and that kind of helped in the top line growth as well as the margin improvement. Of course, the recovery post COVID was also extremely strong, but we are seeing some signs of those earnings moderating as we move along, in this particular fiscal year. And we think this year probably we would still end up with good growth, but there'll be a moderation compared to last year. This is also reflected in the consensus, earning estimate for FY 25 and 26, which is fairly healthy, but it's slowly moderating. So our chief concern with respect to the market was primarily on valuations. So if you were to look at any frontline indices, for example, BC, Sensex, so the valuations remains higher than its historical ranges, and this is more worse in some of the narrow indices, or be it small or mid caps. So one has to be careful in terms of deploying in this market. So our advice to most of the investors is to be extreme, to have an asset allocation plan and to invest prudently into equities within that asset allocation framework. So that's it, friends. Thanks for your patience here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.